And, if you want to write a $50 million check and get into multifamily, you can do that in today's environment. If you want to write a $50 million check and get into industrial or self-storage or office, you can do that. What you can't do today is write a $50 million check and get instant exposure to short-term rentals.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny and the founder of Cattani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny, and I'm joined today by Taylor Jones. Taylor is the head of acquisitions at Techvestor. Techvestor helps people passively invest in short-term rentals through their diversified portfolio. When not acquiring short-term rentals, you can find Taylor on the golf course. Taylor, welcome to the show.
Hey, thanks for having me.
Absolutely. Glad we were finally able to meet. As a lot of my listeners know, I raised capital at the end of last year for Techvestor short-term rental fund. So I'm excited to dive into it. But before we get to all of that, you also have your own portfolio and have been in the short-term rental space. So kind of talk about how you discovered that space, why you like it, and what's kind of led you to Techvestor.
Yeah, certainly. Lifelong sales guy. Traditionally, COVID happened, had a client-facing sales job. Can't go meet people face-to-face anymore. Kind of had that like, oh crap moment. And I've always had the itch for real estate. Never sure what I wanted to do, wholesale, flip, get my broker's license, et cetera. And as a consumer, me and the wife have stayed in Airbnb since 2015. So I was familiar with it from the traveling standpoint, but never really looked at the economics. And finally just decided, man, this looks really good. Let's go for it. So me and the wife, we snagged a couple short-term rentals and I got addicted. And shortly after being in the space for a little bit, got connected with our CEO, co-founder of the fund. He needed somebody to help with the acquisitions as a washed up baseball guy who loves numbers, looking at numbers. It kind of was a natural fit to, start looking at numbers for the portfolio, short-term rentals, underwriting comps, et cetera. And so haven't turned back ever since. And it's been awesome to continue to grow and scale this portfolio.
That's great. I love it. Yeah, it was really awesome to kind of dive in when we were doing our due diligence and just see everything that you guys, the infrastructure that you've put in place to really, create such an awesome opportunity for passive investors to, be in the space without having to, deal with all the management and everything that I think probably keeps people out of it to some degree. Just because if you have one or two, it could potentially cause more of a headache than it's worth, depending on what market you're in. So let's kind of get to that. Obviously now, what is up to 80? How many total in the portfolio now?
Yeah, so Fund 1 finished with 81, and here we are this year in Fund 2 here, 2023. And, we got our eyes set on 200. So we're going to keep pushing forward.
Now, are they all going to be together, or Fund 1, those 80 are going to stay separate and then you'll start over with Fund 2?
Yeah. So, those properties will count and the cash flows being generated will be for Fund 1. And then same thing will apply with everything acquired here in Fund 2. When it comes to, selling down the road, can we sell them jointly to a larger institution who wants exposure? Yes. And I think that's a benefit both funds have from each other, is that instead of saying, hey, here's 81 to buy, it's, hey, here's 300. And so that'll allow for a better exit price, which allows everybody with exposure to Fund 1 to benefit off of the scale of Fund 2. But as far as an individual, basis from the assets and the cash flows, it's very limited to that fund that it's included in.
That's awesome. I love it. That's really a great structure. And I love the exit strategy, right? Because as we've seen, and when it was pitched to us, the institutions are already very interested in the space. As we know, with institutions, they're not just going to come in and buy 1 or 2 or 3 or even 10, right? Before they get into it, they're going to be looking for that 80, 100, 300, unit portfolio. So kind of talk about what the process is for you guys, right? So obviously kind of break it down, right? How you choose your markets, and we'll kind of go from there.
Yeah, certainly. So starting with, where to buy really boils down to the data. So we built our own internal software, and what we're able to do is look at, revenues, purchase prices of homes that hit the MLS across the country, and kind of compare them with some preset underwriting assumptions from, operating margin, and pulling in from revenue data from different data sources. And for us, we're able to underwrite over 100,000 short-term rentals a month in our software. And more or less what it does is helps us not waste time on things that aren't going to pencil for enough yield to make sense, but rather to focus on ones that will. So for us, we're going to track the data, see, okay, where does it make sense to buy? Then we're going to go into that market and vet it for regulation. Obviously, hey, you got to make sure it's legal, or else, it doesn't matter how good the numbers look. If, it's not legal, you can't do it. So once we've, vetted the regulation, the rules, the zoning, then we're going to find out, okay, what's the best product to buy? Does it make more sense to buy 1 or 2 bedrooms and go small? Or does it make sense to buy big 5 or 6 bedrooms and go big, or something in between? And then once we've identified that, we're going to see is what part of town is the money being made? Is it on the north side, the east side, the south side, the west side? So it might make more sense to say, hey, the best revenue opportunities to go buy on the east side of town. So then we'll go over there. And so now we figured out what size bedroom count makes the most sense, what location, and then we can start figuring out what amenities are really driving revenue in that town. So we'll go pull all the top performing listings for any given bedroom count, and we'll start looking for commonality traits. Hey, they all have a pool. They all have a hot tub. They all are 2-story homes. They're all Spanish style homes, or, whatever it might be. And we'll build that commonalities list. And then immediately we'll take that over to, the MLS and see what's available that matches to be able to fit, kind of our buy box and criteria to go out and execute. And from there, once you start putting all those pieces together, you're really able to start making sure you're buying the best available product based on the data, which gives you the best chance to drive the most return for not only ourselves, but our investors as well.
Yeah, absolutely. And one thing that really, really stands out to me is that you're obviously, right, proprietary software, that's huge, but you're buying residential homes and then turning them into the short-term rental, and in this case, really a commercial product, right? Because, we got the economies of scale with the size, but that really stands out because you're not, already buying something that's, a rental product. It's typically just a home, right? A residential home.
Yeah, I mean, most of what we're buying is just a traditional single family home, and then, updating it, renovating it, designing it, furnishing it, and ultimately turning it into, a small miniature hospitality business is really what it is. Most of the time we're not buying already existing short-term rentals. We've bought a handful of them. It would take the numbers still have to work. So it has to make sense for us to still buy an existing one. But typically there's a massive value add creation from taking something that, say, isn't an existing business, renovating it, designing it, adding the appropriate amenities, a hot tub, a fire pit, a game room, et cetera, and turning it into an operating cash flowing business to just continue and go. So that's been a great, opportunity, is taking something that's priced, you can say it's mispriced, it's not an existing business, and you're able to buy it at that, non-business price, drive the cash flow, and then ultimately create a ton of value.
Yeah, absolutely. Like I said, that's one thing that really stood out to us to go ahead and jump into the fund was really that approach, because again, like you said, you're really adding value that really wasn't there to begin with, right? You're kind of forced appreciation as is typically called, which, creates such an awesome return for the investors, which, is another awesome thing that's really stood out for the fund. So we talked about the markets, kind of how you get into them. Talk about why each market. Right now, from what I understand and what we've seen, is not every market is just some destination market where people want to go on vacation. So kind of touch on the other side of it and the diversification of, kind of urban markets and what the approach is there.
Yeah, certainly. So, we definitely want to make sure we have those layers of diversification. So, obviously we have that by bedroom count. We own 1-bedroom homes all the way up to 6-bedroom homes. So, within just the type of, a product and traveling group, we're appealing to, pretty much every group. And then when it comes to where geographically, we own out west, we own up north, we own in the south, we own in the east. And within that, we own mountain properties, we own beach properties, we own lake properties, and we own downtown metropolitan. So we're not overexposed to one geographic area. We're not overexposed to one geographic product type. Like, hey, we have, 81 beach properties. That's great. But, you run the risk of, hey, one hurricane could come wipe you out. Or at the same time, hey, we own 81 downtown metropolitan, and a regulation change or a shift in business travel or a shift in traveling nurses or, whatever your thesis is, could really affect you in that way. So we intentionally built in layer after layer of diversification within the space. So yes, the whole portfolio is short-term rentals, but within that portfolio is additional layers of diversification to make it the best risk-adjusted yield possible for the space.
Gosh, that's awesome. I love it. Yeah, it really is creating a commercial product, which, it is what really caught our attention, because obviously, we're starting to see some groups jump up into this, right, and create these large portfolios and this large product that passive investors can come in. In fact, one group here, Loma Homes, I've had them on the podcast and met them actually at a conference, at a short-term rental, like A to Z day that the local RIA did here, which was really funny because Jeff got up and was pitching it, and I was like, what the heck? I was like, this sounds like Techvestor. And sure enough, they're like, oh yeah, we know CF. And yeah, of course, it's a few players in few big players in the space, which is awesome. So I know one thing that's on people's minds is when or if the short-term rental space will see a dip. There's some regulatory issues like you kind of mentioned before. Now, you guys take a very data-first approach. So what is the data, if anything, showing you in terms of downside, and what do we have in place for downside protection?
Yeah. So, you look at, everything as a whole, and I think because of the increase in inventory, so there's more listings in any given market year over year, which obviously can drive down the revenue per available unit. What you really need to focus on is how to stand out. I think the 2019, 2020 days of, hey, I can just buy an average 3-2 plain vinyl siding home, throw it up on Airbnb and make money. Those days are gone. And so I think those are the people who are suffering and hurting right now. We're very blessed and fortunate to have not only the resources and the knowledge to be able to see, okay, how can we outdesign our competitors? How can we add more amenities than our competitors? How can we buy the best available product for versus our competitors? And so for us, it's finding those advantages that make the most sense to buy and going out and scooping up, as many of those that make sense, whether it's, hey, you want to have a home on the lake, or, you need to have a mountain view, or, hey, you need a big enough backyard to be able to have a bunch of amenities in there to stand out. Whatever it might be, every market's going to give you what's that advantage, which top performing properties you're going to have, and then you're going to go out and execute. At the same time, as we scale, not every single home is going to be a home run. You can't only buy home runs. You won't be able to scale. You'll be able to cherry pick, sit on the sidelines. So for us, even if we say, hey, this home, we don't have the full mountain view like the neighbor, but we are able to buy it at a good basis, what can we add to this home to maximize the value? So for us, it's just about maximizing every possible revenue dollar that this home can produce based on what it is. We can't change where it's located. We can't pick it up and move it. We're not going to add a second story to it or, expand it. So when you look at it, we say, okay, based on these bones, what can we put in here? What can we change, cosmetically, adding in things to make this the best use of this product? And for us, that's how you continue to mix, the singles, the doubles, the triples, the home runs for the baseball reference. And that gives you a nice, great portfolio to blend those all together. So, it's really an advantage versus, one-off investor where you're kind of all in. Your home better work or it better not. And if you didn't buy the right thing or you didn't update it correctly or, whatever it might be, you're kind of stuck. Now, if you nailed it, great, you have all the upside. But I think having the large diversified portfolio gives us so many inherent advantages versus somebody who's buying 1, 2, 5, even 10, is we have those economies of scale. We're able to see things from a macro level across the US. And if bookings are down in one area, well, that's okay because we have exposure to 10, 12, 15 different markets. And, we're not having that risk of being all in on one place.
Totally. Yeah, absolutely. And that's the same reason, right? A lot of people move from the residential space to the commercial space, right? Is that economies of scale and having that ability where, like you said, if 1 or 2 markets are, not seeing the numbers they usually are, you've got 10, 12, 15 other markets that can carry you through. And, oh, by the way, some of these markets have huge events coming up. The Super Bowl's in Phoenix, right? I know the Scottsdale locations are, if not already booked, are, 10, 12xing what they would normally go for. So let's kind of touch on some of these awesome numbers that we are seeing in terms of these kind of special events. Let's specifically talk about the Super Bowl and what some of those numbers are looking like.
Yeah, no, I mean, having something like a Super Bowl just allows you to increase what normally would be a regular, ADR and able to maybe 2x it, 3x it. You also see events that, are annualized. So, hey, this event happens every single year. I've had people talk about like, hey, we own some short-term rentals in Louisville and you got the Kentucky Derbies there every year. So, there is great things that come that give you these huge revenue spikes that are pretty awesome. And, the fact that we have properties all over the country is we can capitalize on those spikes in those various markets, whether it be sporting events, concerts, life events. There's so many great things that, come about, and we're going to capitalize on them as often as possible when we see them, have them, and they fall on our lap.
That's awesome. I love it. Let's kind of switch now to the other side, right? Another big topic is regulation. Now, obviously, the goal is to find markets where they're very business friendly, but from what I understand, even some business friendly states, the micro markets are kind of anti short-term rental. Has that been an issue in, establishing where you're acquiring new places? Kind of touch on the regulation and any battles that's presented.
Yeah. So, there's the difference between short-term rentals are regulated and short-term rentals are legal. So you might see a place where short-term rentals are legal today, and that's just because the local municipality hasn't taken any regulation. So they haven't said, hey, we support them, or hey, we don't want them. They're just kind of that nothing's been there. The risk in investing in a place like that is it's legal today, but tomorrow they could change the rules and now it's illegal and you're stuck with an asset. So that might be good for a one-off individual investor. For us, that risk is too high. So we're going to stay away from places like that where, hey, it's legal today and it's legal when we bought it, but a year from now, 2 years from now, they could change and, we're in a tough spot. It's really good to go into places that have an established regulation, because if they're going to change, normally it's not overnight, number one. Number two, what you end up seeing most of the time is a grandfathering in. So if they're going to make a substantial change, most places will grandfather in and then, hey, now you have to adapt to the new rules, or secondarily, they adopt and go all in and they start collecting a lodging tax on it. So anytime you're dealing with the government and collecting extra money, it's a pretty safe bet to know that they're never going to give up that free gravy train of capital that they're taking in via lodging taxes. So as soon as they start taxing it, they're pretty much never going to go away from it. You look at any action the government takes, they are, in essence saying, hey, we're going to put rules around this, but we're going to tax this so we can continue to make money on it. It's probably not going anywhere. So markets that have established lodging taxes, even though as a consumer, you're like, oh man, there's extra fees that we have to pay this local municipality. Those are more built-in protections for you. So it's really how you approach them and look at them, where some might see them as a negative. We're looking at that as a positive, actually say, okay, great. The government has supported this. They've taken steps to regulate it and they want to make money off of it. They want as many bookings as possible for the largest dollar amount possible for them to put the most money in their own pockets. So those are the kind of things we look for when it comes to an area. In addition to other things that are downstream of that, okay, let's look at supply year over year. Let's look at revenue growth year over year. Are more people visiting this location or are less people visiting this location? So, those are things you can kind of start, top of funnel with to see, okay, the rules, the regs, the zoning, and then you can start, filtering downstream from, okay, what does inventory look like? What does rental demand look like? And those are the factors that will really start checking our boxes to see what makes sense to enter this market or whether it makes sense to kind of hold off.
That's awesome. I love that perspective. And something I didn't even think about, but that's, when you can come in and you're able, you've got the infrastructure to maximize, right? That tax, like you said, as much as we hate those as consumers, from a business standpoint, that is a fascinating perspective to be like, okay, well, that means it's there to stay. So, as long as we can get in and maximize, we know we're relatively safe. So obviously, things are still changing, right? It is still a relatively new asset, especially now as it's growing to this degree where you have, groups like Techvestor growing such large portfolios. Pull out your kind of muddy, fuzzy crystal ball. Where do you see the space going over the next year, 5 years, and, and then kind of the plan for Techvestor?
Yeah, certainly. So for the asset class as a whole, as it'll continue to mature, and, one of the biggest ways something's going to mature and, institutionalize is with lending. And even when you look at, lending options, which, are limited relative to other asset classes today, but even where they were 3 years ago, it was very hard to secure, affordable, very good debt for these properties. And there's more and more lending options coming to the table. I think over the next 5 years, as more lenders start to see this as quote unquote less risky, they're going to see, okay, how can we build lending programs around this? It makes it more institutionalized. And, how we're looking at this is we're going to build this portfolio. We're going to cash flow along the way. And then eventually, yes, we will exit and sell, a bundle of these to an institution. There is still people who want exposure, but do not want to do all the legwork of renovating, designing, furnishing, getting it ready to go. We've done all that for them. All the hard parts that nobody wants to do, we've taken care of that so that institution isn't going to deal with it. And, if you want to write a $50 million check and get into multifamily, you can do that in today's environment. If you want to write a $50 million check and get into industrial or self-storage or office, you can do that. What you can't do today is write a $50 million check and get instant exposure to short-term rentals. So for us, we're kind of building the void in the marketplace that says, hey, here is a portfolio of cash flow, yield, short-term rentals, and it's big enough that you can go write a $50 million check and acquire it or pieces of it or whatever it might be. So I think over the next, few years, you'll see other people building portfolios. And even if they're, not as big, you'll see a $5 million portfolio selling to a, smaller type institution or a $15 million. And, what we're going to build is for that big in-player institution is that, $100 million plus portfolio to sell, of diversified cash flowing turnkey short-term rentals available to operate right away.
That's awesome. I love that. And you brought up a key metric that I want to touch on. Obviously, right now, the interest rate environment is crazy, constantly changing. In fact, I think today we've got another 25 basis point hike. Kind of touch on the debt side and what products are available and what products you're focused on and is ideal, and how you're kind of mitigating and risk adjusting these so that, we are protected on the debt side.
So yeah, we have great debt terms relative to when you look around. We have no floating, no bridge, they're all fixed rate debt of 10 to 30 years. So what is pretty crazy is because we are ultimately buying these single family homes, we are able to secure 10 and 30-year fixed rate debt, which in the commercial space is very much unheard of or does not exist. So what's really great is we're not going to be a forced seller. And that's what we're really want to make sure is, hey, we have these good cash flowing assets. We want to sell them when it makes sense for us and our investors. We don't want to be like, oh, we have this 3-year balloon and it's come due and now we got to refi or we got to sell. And so now we're, our hand is being dealt for us versus we're able to kind of dictate and call the shots. So for us, having all of that 10 or 30-year fixed rate debt gives us a long runway to make sure we can maximize the exit and maximize the value of each property that we acquire.
Gosh, I love that. Yeah, it's such an it's becoming more and more prevalent in terms of how many people are talking about how important debt is. You're seeing it, especially on the commercial side. It's funny because nobody wants to talk about it, which means that it's an issue, right? Like you were at Raise Fest.
Yes.
There's operators there who are underwater right now, and they've got a smile on their face. And, meanwhile, they're back channeling their groups like, are we going to need to withhold distributions? And crap is hitting the proverbial fan, so to speak. And it's really nice. And that's another thing that caught our attention is the debt side and how safe it is, right? Because the hold is 3 to 5 years. So even with a 10-year, if you have to hold longer, you still have that fixed rate. When it comes to the exit, you are seeing where some properties may be underperforming. Is that what it takes to kind of get rid of a property? Kind of here to close it out, touch on, if a property is underperforming, kind of selling it off. And I know if you have already been sold off and will continue to, just kind of touch on that process.
Yeah. I mean, we sold 8 turnkey cash flowing short-term rental properties in Fund 1. Not necessarily for underperformance, but more or less to prove a point. Is there an appetite for people to buy turnkey cash flowing short-term rentals and be able to pretty much get the keys handed right to them? Because like I said, nobody wants to try to buy it, make sure we didn't buy the wrong one, renovate it, design it, furnish it, operate it. So for us, we wanted to see is there an appetite, and there was, and we executed. We probably won't be selling too many more. When it comes to things that are underperforming, things we can do within the fund is what we call continuous improvements. And so there's a reason that each property comes with a level of reserves that we set aside for each property. Is obviously things for, hey, does it have a down month or a down quarter? And you want to make sure you can cover your debt. That's naturally, you want to have reserves for debt, but it's also for continuous improvements to say, hey, maybe we elected not to put in a fire pit here because, hey, we were running tight on the budget or tight on time and we need to get it listed. And we're realizing, hey, that decision hurt us. Hey, you know what? Let's go block off, a down Monday, Tuesday, Wednesday, 3 days, get our GC in there, build out a nice fire pit, add that amenity. Or, hey, you know what? We elected not to paint the exterior. It wasn't our favorite color, but hey, we thought we could get away with it. You know what? Let's go paint it that nice, charcoal black that everybody's doing, or the faded blue, or whatever it might be. So, those are ways you can deal with an individual one. We can test out different pricing strategies, maybe reshoot photos. So we've had times where, hey, let's just change it up. Let's just get a brand new set of photos in and kind of re-scrap it. So for us, those are all advantages that we have being on a portfolio level versus an individual operator, where they're not going to want to throw more money out. They're going to be like, shoot, I'm already not doing well. I'm not paying $7,000 to repaint this thing, or I'm not going to pay $500 to re-photo shoot this. Whereas we say, hey, you know what? That's not throwing away money. That's in fact reinvesting to try to help boost it. Because if we spend $500 to get brand new photos, and all of a sudden we can boost revenue, 500 or 1,000 or $2,000, it pays for itself. And, those are the things we look at on the continuous improvement side is, you're kind of guessing what's going to be the best thing for that property, but the marketplace is going to tell you what is the best thing once you're up and operating for 3 months, 6 months. So for us, that's why we set aside that reserve account, which is something most common investors don't do, is, hey, did we get it right? Or did we get it slightly off and we need to make an adjustment?
Absolutely. I love that. That's awesome. And to come full circle, really taking kind of a residential product and truly creating a commercial product now, right? Trading on cap rates. And like you said, kind of proof of concept. Sounds like that concept was very well proven. And, from what I hear, more and more institutions starting to really take notice, which I'm sure you guys are seeing. I'm sure they're reaching out to you, which of course gets you guys excited and us as investors excited on the exit. Because even with the conservative underwriting, the numbers are still incredible and the returns have been incredible. And And so we look forward to watching that grow and appreciate the insight. And I do want to note, guys, this is a 506c offering. So we are able to talk about it, talk about the numbers and everything. And we'll kind of get to how you can get involved as well if this is something that strikes your fantasy. So go ahead and wind down here. We'll jump to the final five. First question for you. Best advice you've gotten from a mentor?
Best advice I got was jump in. It's scary even when me and the wife were first getting in, and we actually, studied, thought I'd learned enough. And I see too many people with analysis paralysis. They sit on the sideline and they don't take action, and they end up missing out on great opportunities. And so for us, it was scary. Our first short-term rental was 8 hours away, and we didn't drive there. We had to kind of trust our gut and go in. And so it's I'm super blessed and happy that we did. And it was great how it worked out. But best advice I got was take action, jump in. There's no such thing as a loss. It's a learning lesson.
Oh gosh, I love that so much. That's probably the number one answer that I get to that, which is just, it's truly the difference between those who, kind of are entrepreneurs or, kind of going out and taking the risk, and those who aren't. It's literally just the ones who take the action, because that's really the only thing that separates us from others is the action. In fact, I would argue there's probably some very intelligent people with incredible ideas, smarter than me. I'll speak for myself only here. They're far more intelligent than me, but just don't take the action.
Yeah, absolutely.
What is it about your career that makes you feel like you're fulfilling your why?
Great question. For me, being able to potentially set me and my family up for, happiness, balance, I think is really what I strive for each and every day is, okay, can I continue to work hard, doing something that I like, something I enjoy waking up doing, something I'm not dreading, and then ultimately being able to achieve that level of happiness and balance, between work and life. That's what I really shoot out to strive for every single day. And it's really great building this portfolio where we're helping other investors. We're obviously helping ourselves too. And, I think that's great that we get to, kind of build this together with our investors. And the more we succeed, everybody's happy, everybody's making money. And it really is fulfilling, that drive to get up every day.
I love that. That's awesome. Favorite non-real estate or investment related book?
Man, great one I had from the sales days was Never Split the Difference.
Nice.
It's kind of a negotiation and tactic, and you could definitely apply it to the real world. And forget the author's name, but yeah, Never Split the Difference.
That's Chris Voss, right? The ex.
That is. FBI there we go. I knew if you said it, I would recognize it. Yeah, ex-military hostage negotiator.
Yep.
Definitely implemented some of these tactics on a more intense basis than probably you or me might interact with. But
I hope so.
It was a great read that you can apply to a ton of industries and life throughout the world.
Awesome. I love it. If you could have any superpower, what would it be?
Superpower I would want. If the superpower is going back in time, I would take that. If that doesn't quite count, I'd probably take the invisibility one. Nice. I know flying is probably pretty appealing too, but I'd probably take the invisibility one. And there'd be some great times to be a fly on the wall or literally an invisible person in the corner that I think you could yield a ton of great knowledge, insight, or just fascinating, eye-opening things. So that's probably what I would answer that one as.
Could not agree more. Absolutely. I love it. Cool. What's the best way for people to get a hold of you and learn more? And, obviously now that it is a 506c, kind of, give all the info there if you want. Yeah, certainly.
Obviously, hey, you can learn a little bit about us on techvestor.com. I hang out on Twitter and LinkedIn, on Twitter at Mr. Jones STRs, try to put out as much content as I can, Taylor Jones on LinkedIn. And Jonathan is, here helping out. And if you guys want to learn more, he can definitely, get you as much information about the investment opportunity and what we have available for you.
Awesome. Have the economics changed by going directly to you guys in terms of what they were last year? So still the same same return
Yeah.
profile?
So, very, very similar structure. Fund two, we actually have expanded classes of shares. And, the great opportunity is, some of our fund manager partners are able to capitalize on those. So those are great things available to you guys versus coming direct, is you'll actually have more shares available to you. So definitely, utilize that, talk to your investor partner, and, they'll be able to present all the available options to you.
Yeah, absolutely. Shameless plug. But we did get, because of the different tiers that you guys have, we were able to get better return economics for our investors through our fund. So shameless plug there. Awesome. Taylor,
Absolutely,
thank
man.
you so much.
We set it up that way. We love it. We love it.
Thank you so much for your time. This was incredible. Appreciate all the insight.
Look forward to it, man. Thanks for having me on.
Likewise. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.